Hello everyone, I hope you are all doing well. I am an equity research analyst, and in the past I worked alongside financial advisors and investment firms. These days I focus on researching opportunities for my own account and sharing that research with you here. Today we are looking at 5 cheap stocks trading under $10 that I believe offer high potential if you are willing to accept the risks. These are not safe blue chip names, they are speculative, but each of them is operating in industries with massive long-term opportunities. If management executes well, the payoff could be substantial. The first stock we need to discuss is SoFi Technologies. SoFi has positioned itself as a one-stop shop for consumer finance, offering everything from student loan refinancing and personal loans to credit cards, investing platforms, and even full banking services. The turning point for SoFi was receiving a national bank charter, which gives it the ability to hold deposits and lower its funding costs. This is a huge edge compared to many fintech competitors who rely heavily on outside funding. SoFi has seen its customer base grow to more than 8 million members, a rate of growth that outpaces most traditional financial institutions. In its most recent quarter, revenue came in close to $600 million, showing both diversification and strong growth across lending and technology services. While profitability is still a concern, analysts are beginning to revise their estimates upward, which is usually a good sign of institutional confidence. If SoFi continues building brand loyalty and cross-selling different services, this stock could realistically double in the next 2 to 3 years, making it a compelling buy for risk-tolerant investors. The second stock on the list is Opendoor Technologies. Opendoor is trying to reinvent how Americans buy and sell homes through its iBuyer model, using algorithms to purchase homes directly, renovate them, and resell them. Real estate is one of the largest industries in the world, and disruption here could mean incredible upside. The company's stock price has rebounded sharply, gaining more than 300% over the past year. This kind of move reflects both speculation and renewed hope that Opendoor can survive the difficult housing cycle of the past 2 years. There are clear risks here. Rising interest rates and weak housing affordability hurt demand, and Opendoor's balance sheet has been under pressure. But the fact that major institutional firms have taken new positions in the stock suggests there is growing belief in the turnaround story. If housing conditions stabilize, Opendoor's technology-driven model could give it a cost advantage over traditional brokers. That is why I consider this a speculative but interesting buy under $5. The third stock, OfferPad Solutions, is a smaller competitor in the same space as Opendoor. At first glance, OfferPad looks like an even riskier bet, given its much smaller size and history of financial struggles. Yet the company has shown progress in cutting costs and streamlining its operations. Shares have recently surged after management improved its earnings guidance, which is a sign they are finding a path toward efficiency. Because OfferPad trades below $2, the market is pricing in very little chance of long-term success, but in investing, asymmetric opportunities can be attractive. If the iBuyer model survives and demand for simplified home buying and selling continues, OfferPad could see a multiple expansion that creates outsized returns. I would caution that this name should only be considered for a very small portion of a speculative portfolio, but its risk-reward profile is hard to ignore. The fourth stock worth analyzing is Upstart Holdings. Upstart is not in real estate, but rather in lending, using artificial intelligence to assess credit risk. The company believes that its algorithms can better identify qualified borrowers than traditional FICO scores, making lending more inclusive while still profitable. In its most recent quarter, Upstart generated over $130 million in revenue, a drop from its peak, but showing stabilization after a very difficult 2023 and 2024. What makes Upstart compelling is the long-term vision. Over 70% of its loans are now fully automated, and the lending market it addresses is in the trillions of dollars. If its models prove accurate through different credit cycles, Upstart could gain the trust of more banks and expand its partnerships significantly. The risks are clear. If the economy weakens and defaults increase, Upstart's business will be hit hard. But as an equity analyst, I see asymmetric optionality. A company that proves its AI works in lending could become a leader in fintech for the next decade. At current levels, the upside is much greater than the downside, which makes it a speculative but attractive buy. The fifth and final stock is Lemonade, which is attempting to disrupt the insurance industry. Lemonade uses an AI-driven platform to provide renters, homeowners, life and pet insurance. Its appeal lies in offering a digital-first, user-friendly experience that resonates with younger generations. Today, Lemonade has more than 2 million customers and has reached annual revenue above $500 million. For comparison, traditional insurers generate tens of billions in revenue. That means Lemonade is still tiny, but it also highlights the room for growth. The concern here is profitability, as Lemonade is still burning cash and navigating strict regulatory frameworks. However, insurance is a massive industry where consumer frustration with legacy companies is common. If Lemonade can scale, reduce losses, and eventually cross into consistent profitability, it could easily trade at multiples of its current valuation. Investors who are patient and willing to wait several years might find that buying Lemonade today offers a rare opportunity to get in early on a long-term disruptor. To bring it all together, the 5 cheap stocks we discussed are Sophie, Opendoor, Offerpad, Upstart, and Lemonade. They each have risks, but they also share something in common. They are disrupting industries that are enormous in scale, whether it is finance, housing, lending, or insurance. When you buy companies like these, you are not just buying their current revenue numbers. You are buying into the possibility that they become dominant players in trillion-dollar markets. That is where the potential for multi-bagger returns comes from. As with any speculative investments, allocation is key. These stocks should never make up the majority of your portfolio, but holding a small basket of them could deliver significant upside if even 1 or 2 of them succeed. Thank you all for joining me for this breakdown. If you found this analysis useful, make sure to subscribe and leave a comment about which of these names you are most interested in. I will continue bringing you equity research insights so you can navigate the market with more confidence. Until next time, take care and keep investing wisely.